Hi traders, welcome to this edition of Expert Market Analysis brought to you by Errante. This is generally a bi-weekly review and preview, so every other week of the market's key events and trading opportunities. Whilst I'll just let you have a quick look at the disclaimers, I'll just run through some of the key objectives of the webinar. We think markets are generally driven by themes which buyers and sellers relate to in order to enter and exit markets. These stories or narratives can be long-term fundamentals or short-term themes that increase or decrease in importance over time. Our goal is as well to break down all the market jargon and complexities that you read about. So if you do have any questions, please do ask them along the way, and we'll be more than happy to try and answer those as we go, or at least at the end of the webinar. Okay, so we will spend about 30 minutes, hopefully, just looking at some of the main themes of the moment, the geopolitical one, actually, and as well the Eurozone theme and the passing of the fiscal reform in Germany. Just before we get into that, I'll just pull up a Euro-dollar chart, actually, which is interesting, just taking a touch of a move lower at the moment. Here's the Euro-dollar chart as we speak. Market's pretty mixed, actually. European bourses lower, along with Asian stocks, actually, and US futures are just picking up, actually, and just in the green. The dollar is actually firmer ahead of, obviously, this risk-packed week. Although sort of over the weekend, we didn't have that much news flow, really, aside from Trump reiterating he has no intention really of creating exemptions on steel and aluminium tariffs, and adding that he will impose reciprocal and sectoral tariffs on April the 2nd. That is the major date for markets, we think, at the moment. After we get through this week and the Fed, obviously, we've had the Bank of Japan and also the Bank of England meeting. Then we do have core PCE data at the end of next week. But otherwise, then the April 2nd date is a key one for markets and these reciprocal tariffs. Interestingly, I think Scott Bessent, as I say, has been quiet with tariff news, but Scott Bessent, the US Treasury Secretary yesterday, I think, just mentioned that those tariffs would be 25%, may not be double, so plus 25%, and would come in numbers. So maybe in different grades of 1, 2, 3, depending on those how big those tariffs are, the reciprocal tariffs, that is. So yeah, just getting more speculation. I'm sure we will in the build up to that April 2nd date. Otherwise, Euro has been a big theme, of course, for markets in the last few weeks. Bid, of course, and rose to a new cycle high actually yesterday at 109.54. We're just selling off here now at these highs. You can just see, well, we've got the Keltner channels in here, and we're just above the upper band really, and we're also overbought slightly, although that's easing now on the daily RSA. Interestingly, whether we've got some negative divergence there between making a new high in price but not in the RSI, so potentially we move lower. That's euro dollar. And probably in a way it's a bit of a buy the rumor, sell the fact kind of event, although we have had obviously the Bank of Japan meeting overnight, but there has been some, of course, there's some dollar strength now and the euro weakening this morning. Yes, that vote though otherwise was passed in the Bundestag on the German reform package. It now goes to the Bundesrat on Friday with expectations for approval there. Basically the CDU, the CSU, and then also the SPD and the Greens, crucially, all supported the proposal. It's really this huge shift towards fiscal spending that has got the markets very, very excited, really, seeing this big push up in the euro, and also that's dragged in dragged higher other European currencies like sterling, actually. So yes, the hope is then that it influences really EU level agreements on increased spending, defense spending that is, and also borrowing potentially. Although has to be said, growth impacts depend really on rising production capacities in Europe. For the ECB, interestingly, we do get to hear from President Lagarde tomorrow. where she could hint possibly at a pause in the rate cutting cycle. There's about 13 basis points still priced in for a cut for that for the next meeting. So there is some capacity for that to move. The ECB at the moment anticipates upside risk to inflation and growth from that German package, which then should support a slower pace of rate cuts potentially. Germany, of course, will experience a positive demand shock, but the bulk of those, the growth impacts really will occur, let's not forget, probably next year and beyond, and then GDP potentially rises by 1 to 2% in 2027. So just bear that in mind, of course, even though this is a huge fiscal historical moment really for Europe by releasing the debt brake, if you like. So euro dollar, just as we touch on this, there's not a lot of other European data out this week. So yes, just possibly overbought, may see some a correction. Support looks good around those recent lows and the 61.8 of this September decline. That is around where 108.17, I think. Yeah, so that should be decent support. Otherwise, of course, resistance is probably that recent high at 109.54, and then above that, the next fib level is at 109.91. So, yeah, interestingly, we just sort of topped out at the moment around those highs from November, which was obviously the pre-election US election high, of course. Then we had that dip down, sort of base building around 102, just above, and then obviously this huge push higher with the dollar going lower. Okay, that's euro dollar. Otherwise, interestingly, Antipodeans, Aussie, Kiwi, they recently benefited actually after the weekend from constructive Chinese activity data, and also China unveiled a plan to boost wheat consumption. They said it would vigorously boost consumption actually and expand domestic demand in all directions. The plan is to raise is to focus on raising incomes, stabilize the real estate and stock markets, and improve the social safety net. Yeah, not a lot of detail actually, and we've given back a lot of those gains that you can see. For example, the Aussie, that big, decent push higher actually, up through the 100-day moving average, but then resistance around 64, and we're back sort of down towards the 50-day moving average, that blue line at 63.13. Otherwise, major question really, the big theme is for investors right now really is how hard the Trump administration, Washington, will really push this reset agenda that we're seeing on global trade and, of course, security as well. Equities, certainly, they've been vulnerable to comments that the administration is prepared to accept a slowdown or perhaps even a recession, really as it ushers in a complete reset on those two big ideas. Given the prospect of sizable tariffs coming in early next month, as we've already mentioned, against Europe and Asia, then it's likely risk assets will remain fragile pretty much on a near-term, medium-term basis potentially because of this uncertainty abounding as we get to, well, the start of April and possibly beyond. It'll be interesting, yeah, how much clarity we get after that April 2nd date for sure. Also in focus, of course, this week, as I mentioned, geopolitics. Donald Trump met the Russian President Vladimir Putin yesterday. He said he held a good and productive phone call to discuss an end to fighting. Basically, it did not agree a full ceasefire, but it did agree to a 30-day ceasefire on energy and infrastructure assets. President Zelensky in Ukraine was positive around this. But of course, Putin hasn't so far, he's so far deflected efforts essentially to halt the fighting more generally, as he insisted on conditions that would be difficult for Ukraine to accept. So that is a barrier really. Of course, any progress, more progress will probably be further good news for European FX. And of course, could see some more selling in the dollar. Busy week, of course, for central bankers, as we mentioned or will talk about shortly. The FOMC, of course, we have the Bank of Japan, we've got the Bank of England tomorrow as well, Sweden, Switzerland tomorrow as well, Brazil and Indonesia all this week. But probably in the G10 space, only Switzerland is expected to probably cut rates. Yeah, so that's where we are currently. Just moving on to equities briefly then. They moved lower yesterday. If we just pull up an S&P chart actually, which is here, and you've got this long-term bull channel, of course, rising series of rising highs, or higher highs, higher lows, sorry. And then we've just sort of broken down through the bottom of that channel there, and then through the 200-day moving average on the this is the S&P 500, that 200-day moving average at 57.43. So we're still below that. Just a very short-term bear channel now, although we might have broken down through it, but I could pull that up shortly. We are out of the lower band of that counter channel, and we're sort of not as oversold as we were. So potentially just a short-term correction before then more selling occurs. Of course, there's strong support if we put it back to 55.20. That's a long-term fib level that you can see here from that low in 2022 up to the record high. So the 23.6 fib retracements at 55.20 tallies with that low from a Thursday last week at 55.04. So around 5500 should be decent, really decent support, and that is actually a fib level of the move from August up to the record high. That's at 55.10 as well. So around 5500, strong support zone. Breaking that, then we're going lower towards probably the swing low from September last year, around 5400. Yes, but global equities generally were lower, and really it's been this US indices pulling down global indices, really. Europe, on the other hand, the belief, of course, that Germany would pass that spending package grew through the day yesterday, and that led the indices higher, although they're lower today, of course. And it is really, yes, again, not just a euro, but of course stock markets as well, where there's been this turnaround from an exit out of US stock markets and US tech particularly, and also the Magnificent Seven into other cheaper markets. Questions around the infrastructure spend on AI, on valuations, of course, and then just the fact that other markets all represent better value. And Germany now is outperforming the US actually by more than 15% year to date in local currency, by more than 20% when measured in common currency. And in the US, once again, as I've mentioned, the Mag 7 and cyclicals now continue to be under pressure. Banks, they did have a better day, finishing as the best performing industry yesterday on the S&P 500, but generally it is this rotation which has, of course, got everyone's attention. If I just show you a couple of charts, actually. Firstly, this one, so it's just the S&P 500 relative to, well, global stocks. So the MSCI, that's an index, the all world ex-US index, and you can just see how, yeah, we popped higher just before the start of this year, and then now we've moved sharply lower, potentially out of the bull channel, and especially down below the 200-day moving average. Really interesting that, and this, yeah, just exemplifying this shift, as I've said, away from US exceptionalism. Also then, this is what we just talked about, which is then the German DAX index relative to the Magnificent Seven stocks, and you can just see that just huge outperformance of Germany since December 24th, actually. The DAX has outperformed the Magnificent Seven by 56%. And you can just see then that sharp reversal in that line, really back to 100, which is where we were back in January 2024. One thing, other thing to note actually is the Bank of America survey published yesterday actually. So this is a survey of the biggest fund managers in the world, hundreds of fund managers actually surveyed, I believe. And it shows the biggest switch on record by fund managers out of the US over the last 4 weeks. And as with prices themselves, the turn when it has come, and here, just to show you, well, I haven't got that chart actually, but when it came, it was sudden and dramatic, and yes, sort of record switch out of the US into Europe, into EM markets, not Japan, but Europe and EM being by far the biggest. Yeah, winners of that rotation. Just another final chart. This is from an investment bank, ING, and it just shows you just the differences. Actually, just another way between the dollar, the S&P 500, and also the US 10-year Treasury, and just the difference between the first term in grey and then the second term. And you can just see the dollar kind of mapping where it went in Donald Trump's first term. Potentially then we have more downside to come in the dollar, but interestingly the S&P 500 turning much sharply lower in this second term compared to the general bull trend that we saw in Trump's first term. Okay, let's move on now to just quickly we'll look at the Bank of Japan meeting. I'll just pull up the dollar yen chart first of all. Which is here. And you can just see the downturn and then this break potentially out of this channel. If I just put on a channel here, depends where we put the lows and the highs. Pretty much around there. It's better to obviously tap some price points, of course. That's what you need to do, and the more you tap, then the stronger that sort of channel is. And you can just see we're at the top of the channel now of that bear channel from those highs in well, earlier this year at 158.87. Bank of Japan meeting overnight just happened actually. They did leave rates unchanged as expected at 0.5%. Meeting probably though was a touch more hawkish than expected, even though, well, we saw dollar yen go higher, then move lower actually once Governor Ueda was speaking, but now we're higher again in dollar yen, so the yen weakening. As I say, meetings perceived slightly more hawkish than expected. The domestic economy is continuing a gradual improving trend. The bank said private consumption has been on a moderate increasing trend as well, despite the impact of price rises and other factors, as is business fixed investment. CPI ex fresh food has been in the range of 3 to 3.5% recently amid rising services prices. That's wage increases, of course, and then also a rollback of government energy measures. The Bank of Japan expects the economy, crucially, to keep growing above potential, with really overseas economies continuing to grow moderately, and this sort of virtuous cycle, if you like, from income to spending, which is gradually intensifying. Underlying CPI inflation is likely to be at a level, they said, policymakers, that is generally consistent with targets. Of course, we've got those, the Shunto, the spring wage negotiations happening currently, so they will be, officials will be keeping a key eye on those. Also, the bank did highlight, of course, international developments regarding trade as an important risk to the outlook. Otherwise, though, domestic developments do suggest room to gradually normalize policy, and the Bank of Japan is ready to adapt the timing, of course, to any international uncertainty that develops. The next BOJ policy decision is on May the 1st, I believe, and the next sort of price hike not for a couple of months after that, potentially. So yeah, interesting meeting, touch more hawkish possibly, but we're not seeing that reflected in yen strength. If I just look though at, say, euro yen, that's flat on the day. Sterling yen moderately positive actually, so the yen is struggling a little bit here. Kiwi yen is down, Aussie yen down as well, but only marginally. So yeah, interesting move. Yeah, just to the top of this bear channel. Whether we break out of that, then next upside level would be the fib level here, 38.2 of this September to January move. That's a 150, 150, and then you've got the Black line, that's a 200-day moving average of dollar yen at 150, 188. Otherwise, strong support around 146.94, 147, where we came in the lows in the middle of last month. Okay, moving on from that, let's get to the main events of today and tomorrow. So the Fed, first of all, just going to pull up a graphic which has all the main numbers that the economic data really that we've seen recently. The Fed, yeah, very much expected to hold rates at well, between 4.25%, 4.5%. Markets will be looking basically to the Fed statement and then the quarterly updated economic projections and dot plots, as well as commentary, of course, from Chair Powell in his press conference. All comes amid the sort of weaker economic activity data that has been coming out of the US of late, underpinned, of course, by fears over tariff policy. There has been a lot of press as well around the Atlanta Fed's GDP Now model, which is tracking growth of, I think, negative 1.8%. That's down, if you like, or sorry, up from the negative 2.4% reading, which has got a lot of press. Many have suggested actually maybe overstating the gloom, well, due to sharply higher gold imports, which do not directly impact activity. Although the model, when you look at it, gold actually, or adjusted for gold, tracking estimate just barely negative actually, so still in contraction but less severe than its headline. Aside from that, well, the Fed will be looking to see whether Chair Powell reassesses his view that the central bank is in no hurry to reduce rates in the near term. That is very likely. He is very likely to continue with that phrasing and messaging, basically on hold and waiting and watching. I'm just looking for one of the major central banks, actually. Just bear with me 1 second. Who termed the Fed, I quite like this, what they would be in watchful waiting mode, which is pretty much what we're saying. That's Goldman Sachs actually saying that about the Fed. Yeah, so in no hurry really to reduce rates in the near term, kind of caught between slowing growth and elevated inflation expectations, certainly at the moment. Remember that in the dot plots from December, the Fed penciled in rate cuts that would take the Fed funds rate to 3.75% to 4%. So that was 225 basis point cuts this year. And then rates were seen falling further over the forecast horizon to 3 to 3.25% by 2027. So watch to see if there are any changes to those projections. Most, I think, probably think there won't be, so that's consensus. So any changes would cause volatility, possibly. As I say, there will be upward revisions to near-term inflation forecasts and then downward revisions to growth, which of course sparks potential questions around stagflation. Money markets, then, they are pricing in, well, the first fully discounted rate reduction isn't until June, with around 60 basis points or so of cuts currently priced in through to the end of the year. That means, of course, 2 fully discounted 25 basis points cuts and around a sort of 44% chance of a third. That's much more than just a few weeks ago, and kind of comes after the softer CPI numbers, of course, and then inline non-farm payrolls. The issue, as I say, is probably the fact that inflation expectations, because of tariffs, potentially are moving higher. Just to bear in mind as well, Chair Powell, he does have a fairly decent track record actually of saying the right things to calm the stock market. So that'll be interesting to see what he says about that. And certainly if they do stick only to 2 cuts, you would think it may give some support to the dollar, of course, being that there is 61 basis points of easing priced in at the moment. Markets may, though, look through this meeting, just simply because they'll have the eye on, well, core PCE data out next week, and then of course that April 2nd date again that we've talked about. Okay, yeah, that's the Fed limited guidance then, basically awaiting Trump's policies. We did get just on the inflation front. So recently we got actually last week the cooler set of CPI numbers that I just talked about. Really, 0.2% was month on month for headline and core versus predictions of 0.3, so lower than those estimates. And then that pulled down the rate of headline annual inflation to 2.8 from 3%, while core slipped, as I said, dipped to 3.1% from 3.3%. Just to 3 decimal places on the month-on-month change in core, that was actually 0.227. So it does remain above the 0.17% trend that is needed to average over a prolonged period, really, to bring inflation down to the Fed's 2% year-on-year target. Of course, encouraging news, but as I say, those inflation expectations are more worrisome going forward. Also, I should say on that CPI number, some of the dampening effects actually on those figures, basically lower airfares, probably not going to be reflected in the PCE data. That is the Fed's favored inflation gauge, as I mentioned, which is released next week. Although, again, airfare weakness may possibly be a further sign of softer consumer demand. Yeah, so this is just then the Fed funds rate against that PCE indicating. You can just see the dotted line, which is the 2% target, and we're still above that, although possibly easing slightly in the months ahead. If we just pull up now the dollar index chart, which of course we always say has a heavy weighting towards the euro, around 56, 57%, I believe. So yes, here's the dollar just consolidating at these lows. Really interesting now. Quite a long consolidation, no breakdown through the recent lows. So really sort of very strong support at the moment, initial support around sort of 103.30 area. If we break that, then yeah, we'll probably go quite quickly down to 102.30, which is that fib level of this September rally up to those highs in mid-January at 110.17. So potentially, yes, initial support around 103.30, break that, which interestingly tallies with that swing low from November, again, that pre-election low, so symbolic low there. If we do break down through this, then as I say, because we're consolidating and there's quite narrow range contraction, essentially narrow ranges means potentially then the breakout will be fairly sharp and aggressive, and we'll see range expansion. So potentially should be in line with the dominant trend, but we'll see whether we can break 103.30. If so, then 102.30 probably happens quite quickly. Otherwise, we need to get above probably 104, that recent high from last Friday at 104.09, tallies as well with that 61.8 at 103.98. So just sort of initial resistance zone around 104 in the dollar index. Okay, moving on from the Fed, we'll just look now at the Bank of England meeting as well. We've got another graphic here, just highlight the main numbers again. The bank similarly, well, expected to remain on hold. That keeps the base rate at 4.5%. Key really will be whether the MPC reinforced market pricing towards a cut at the next meeting on May the 8th. That is when the BOE actually issues its next quarterly monetary policy report, the MTPR, which then includes, of course, updated projections to the last forecast that were issued back in early February. Just since the prior meeting, of course, UK CPI has risen, the headline to 3% from 2.5%, the core to 3.7 from 3.2, and then services also jumped to 5% from 4.4, although that was lower than the MPC's forecast of 5.2%. Jobs data is due actually tomorrow morning, just before the announcement. but recent data sort of characterized by really sticky wage growth and also ongoing upside in the jobless rate, although there are statistical issues around that data collection. From a growth perspective, well, January GDP was negative, but these numbers, the monthly numbers at least, are volatile. More timely survey data probably is probably slightly more significant, and the composite still remains above 50. I think 50.5 versus the previous 50.6, so just around, still in expansionary territory, as I say. The MPC generally, so it's expected to lean towards focusing on its inflation mandate, probably with a 7-2 vote split, with Dhingra and Mann still being the lone dissenters, although it will be unclear kind of what magnitude of cut they will back. There is some range of views actually here, with possibly Taylor potentially joining those dissenters, although others actually think Mann will return to the unchanged camp after backing that very surprising 50 basis point rate cut last month. The bias, though, likely to lean that way, really, with communications reinforcing this sort of gradual and careful approach to further withdrawal of monetary policy restraint that is appropriate, and that policy will be restricted for sufficiently long. That's the expectations. Anything different then will change, affect sterling, and of course then this sort of 50 basis points of rate cuts that are priced in currently. Note, of course, that is less than the 60 basis points or so that the Fed has currently, and sort of one of those reasons why we're seeing upside in sterling against the dollar. If we just pull that up, actually, so we'll pull up cable, just bear with me 1 second. And that chart is here, so you can just see similar chart to the euro dollar in a way, downtrend from that September high down to sort of January lows. Sorry, this is euro dollar. No wonder it looks the same. But if we just pull up cable, okay, not too far off. We've got a down channel. We haven't drawn that. We just put a downward trend line, which we broke in January, dipped below it early February, but then build a base around 124.14. Obviously that comes after the 134.34 high down to that low at 121 or so. Yeah, then just broke that downward trend line, did dip below it, but then found the base around 124 and then have moved higher quite nicely, and we're just backing off those highs from yesterday. Levels last seen in November, of course, around the election again. That was at 130.09. So just may see a pullback of initial support potentially around these recent lows at 129.24. That's a 61.8 fib level as well. So should be fairly significant support, you think. If we do lose that, then possibly then down towards, well, the 200-day moving average and the 50-day moving average. Interesting. That's 50-day just moving above the 200-day potentially, but that is all around sort of 128 or so as a very strong support zone. Otherwise, yes, we need to break 130 decisively then, and possibly up to 131.48, the next upside level. We are overbought though on the daily RSI, so possibly some correction being seen in the near term. Okay, we'll wrap it up there. Thank you so much for joining us. Really do appreciate you being on the call. Don't see any questions at the moment, so hopefully that is all clear. Of course, lots going on in the markets, so do be careful with position size, and of course risk management being a key consideration as well. We are not back now for a few weeks actually, so we have I think at least 3, maybe 4 weeks before our next webinar. So please do join us then, and take care. Okay.